Copper has staged a fantastic comeback from this time last year. In March 2020, it became clear that the world was in the grip of COVID-19. Prices fell to their lowest in more than 4 years. Manufacturing in China, which is the world's biggest consumer by far, had ground to a halt. Mining by some large producers, such as Peru, also fell, as companies had to bring in new health protocols. But the slump in demand was far greater. Fast forward to now, and it's a very different picture. Copper prices are above $9,000 a tonne, more than double what they were at their lowest last year, and up sharply over a 12-month view. So what has prompted such a big turnaround, and will it be sustained? Essentially, supply worries grew, while the Chinese economy rebounded more quickly and more sharply than expected, helped by stock building and record high copper imports, which jumped by almost 1/3. Earlier forecasts of a contraction in demand for China switched to an increase of over 2%, and this helped global demand to post a small rise. China's demand growth is expected to remain robust this year at around 3%, helped by infrastructure investment. However, there are fears that last year's stockpiling off exchange in China, including by the State Reserves Bureau, may act as a constraint, and recent rises in exchange stocks from low levels are giving some cause for concern. With supply expected to pick up pace, it may be up to other major economies to take up any slack this year if copper is to avoid a small surplus. Certainly, the election of Joe Biden as US President has boosted optimism in that regard, not just because of massive stimulus, but also because his green energy policies point to more copper-intensive usage, for instance in electric vehicles. With other countries now more likely to follow America's and China's lead in this area, the signs are that there could be a step change in copper demand long term. At the moment, though, copper prices do look to be running ahead of themselves by already factoring in this long-term bullish picture. A test of the record highs above $10,000 may be almost inevitable this year, but fund managers have recently cut their long positions, and we feel that an easing of supply and a market that is balanced or tending to surplus will temper gains. We've updated our mine numbers and now estimate that world output grew by a modest 1.5% year-on-year in the fourth quarter of 2020. For the year as a whole, our mine production screener, which includes all latest company reports, shows a decline in 2020 of about 1% to around 20.3 million tonnes. Critically, this comes on top of zero growth the previous year. Current mine supply tightness is being reflected in smelter refinery treatment charges, which are at their lowest in more than a decade. However, we do see this situation improving in the next few months as the concentrate output picks up. We're looking for mine production to return to trend growth this year at close to 3%, and for this to continue in the medium term. And this, combined with reasonable but not spectacular demand growth, should prevent large deficits over that time frame. But new mine projects do need to be committed soon to meet the expected step change in demand growth. However, with prices above the incentive price of $7,500 per tonne this year, we would expect that pipeline to start filling